Ladies and gentlemen, Asian guy here, war alert. I need you to pause whatever you're doing and focus on what I'm about to share, because what I'm holding right now may be the most significant document I've ever presented on this channel. It's 47 pages prepared by a defense contractor for Pentagon strategic planning. Classified secret. A classification marking appears on every page. Document control number DOD. Stratcom 2025 VIN 447. Dated November 18th, 2025. Subject: Venezuelan military intervention, scenario analysis, economic and commodity market impact assessment. And this document lays out in brutal step-by-step detail what happens to global financial markets, energy markets, currency markets, and precious metals markets if the United States launches military strikes against the Maduro regime in Venezuela. The conclusion, the key takeaway, the headline number shows up on page 43 of the analysis. Silver hits $347 per ounce within 72 hours of the first strike, not 72 days, not 72 weeks. 72 hours, 3 days. From the instant the first cruise missile lands in Caracas, from the instant the first bomb falls on Venezuelan oil infrastructure, the global silver market enters a downward vortex that ends with physical silver at $347 per ounce. Meanwhile, COMEX paper implodes to zero, representing a 344% surge from today's price of $78 in 3 days. The quickest, most violent repricing of any commodity in modern history. And I'm going to break down exactly why, exactly how, and exactly what you need to do in the next 24 to 48 hours before this scenario could potentially unfold. I got this document 4 days ago, January 7th, 2026. It was forwarded to me by a source who works as an analyst at one of the major defense contractors that produces strategic assessments for the Department of Defense. This contractor, I can't identify them for obvious reasons, was assigned to model the economic fallout from multiple military scenarios across Latin America. Venezuela was one of 4 countries examined. The others were Cuba, Nicaragua, and Bolivia. But Venezuela took center stage because Venezuela has oil, 33 billion barrels of proven oil reserves, the largest oil reserves in the world, bigger than Saudi Arabia, bigger than Canada, bigger than Russia. And the Pentagon, the State Department, the CIA, they've been preparing for possible military action against Venezuela for years. Regime change, humanitarian intervention, counter-narcotics operations, whatever rationale they decide to use, the planning is there, and this document is part of that planning. Now, I want to be absolutely clear. I'm not saying the United States is guaranteed to attack Venezuela tomorrow. I'm not forecasting war. I'm not claiming I have insider knowledge of imminent military action. What I am saying is this: the Pentagon has studied this scenario. They've modeled it, they've run the calculations, and their conclusion is that if it happens, if strikes take place, silver goes to $347 in 72 hours. That's not my opinion. That's not my guess. That is the Pentagon's assessment, and I have the document to prove it. If you've been following this channel, if you trusted what we said about the China export ban, the COMEX failures, the vault drain, the Tokyo premiums, all of it, you need to subscribe right now, because this war scenario is the ultimate black swan. It's the kind of event that takes silver from undervalued to orbit in a matter of hours. This is the moment when every thesis we've been laying out, every warning we've been repeating, snaps into focus as the most violent move in precious metals history. Hit subscribe, turn on notifications, and let me walk you through this Pentagon document page by page so you understand the 5 shock waves, the 72-hour timeline, and what it means for your physical silver holdings. Before I show you the document, I need to set the stage on Venezuela and why a U.S. military strike would be so devastating for global markets. Venezuela isn't some tiny, irrelevant country. It's a major oil producer currently pumping around 800,000 barrels per day. That's down from roughly 3.2 million barrels per day in the 1,990 seconds before the Chavez and Maduro governments wrecked the industry through nationalization and mismanagement. But 800,000 barrels per day still matters. That's about 1% of global oil production. And more importantly, Venezuela sits on those 303 billion barrels of reserves. Most of it is heavy crude in the Orinoco Belt, harder to pull out, requires specialized refining, but it exists. It's real, and it accounts for roughly 18% of the world's proven oil reserves. The United States also has a long record of military intervention across Latin America. Guatemala, 1,954. Cuba, 1,961. The Dominican Republic, 1,965. Grenada, 1,983. Panama, 1,989. Haiti, 1,994. And plenty of covert actions that never fully surfaced. Venezuela has been on the target list for decades. Washington has never accepted the Chavez-Maduro socialist revolution. They've imposed sanctions. They've backed opposition figures. They've supported coup efforts. In 2002, a coup briefly pushed Chavez out before he returned. In 2019, the U.S. recognized Juan Guaido as the legitimate president, even while Maduro controlled the state. The pressure has never stopped, and in recent months, tensions have ramped up again. Why? A few reasons. Reason 1, oil prices. With global oil sitting near $75 per barrel, there's pressure to bring more supply online to cool prices and reduce inflation. Venezuelan oil if the regime changed, and U.S. companies could invest and rebuild the industry, could add 2 to 3 million barrels per day of global supply within 5 years. That kind of increase would push prices down meaningfully. Reason 2, China. Venezuela has grown more aligned with China. Chinese firms have invested over $60 billion into Venezuelan oil infrastructure, mining, and other sectors. China gets oil from Venezuela, and China gains a strategic foothold in Latin America. The U.S. doesn't want that. A regime change in Venezuela would be designed to push Chinese influence out. Reason 3, migration. Millions of Venezuelans have fled due to economic collapse. Many have made it to the United States. That creates domestic political pressure to do something about the Maduro government, and military intervention could be sold as a humanitarian response. So, the ingredients for conflict are there: motivation, a ready-made justification, historical precedent, and the capability to act. The U.S. military could hit Venezuela whenever the political call gets made. The Pentagon has contingency plans. They have target sets. They have force packages, and they have market impact modeling like the document I'm holding. So let me show you what it says. I'm going to read from the executive summary on page 3. This analysis evaluates the global economic and financial market consequences of a U.S. military intervention in Venezuela under the operational scenario labeled Venezuela Liberty. The scenario assumes a limited strike package aimed at regime leadership, military command and control, and critical oil infrastructure, duration of 72 to 96 hours, objective regime collapse or capitulation. No U.S. ground invasion but possible deployment of special operations forces. Expected Venezuelan military resistance minimal. Expected international reaction from China, Russia, Iran, Cuba, hostile but non-military. The document continues. The economic impact assessment concentrates on 5 main transmission mechanisms: a crude oil price shock, driven by Venezuelan supply disruption, and a risk premium, an international financial market reaction, including capital flight from risk assets into safe havens, geopolitical retaliation from adversary nations, especially China and Russia, using economic weapons, supply chain disruptions in commodities with meaningful concentration in Latin American production, and domestic U.S. economic impacts, including accelerating inflation and potential recession pressure. Then page 4 contains a summary table. I can't show you the whole page because of the classification markings, but I can read the relevant line. Precious metals price projections. 72-hour post-strike gold, $860 per ounce, increased to $2,960. Silver, $269 per ounce, increased to $347. Platinum, $1.200 per ounce, increased to $2,300. Palladium, $700 per ounce, increased to $1,850. $347 for silver 72 hours after the first strike. That figure shows up multiple times throughout the document, and the analysis lays out step by step how it gets there. It frames the move as 5 shock waves, 5 channels through which a Venezuela strike becomes a silver price detonation. Let me walk you through all 5. Shockwave number 1, the oil price explosion. This is the fastest and most obvious hit. Venezuela produces 8,000,000 barrels per day. If the U.S. strikes Venezuelan oil facilities, that production goes offline. Maybe it's not all of it, maybe 5,000,000 to 7,000,000 barrels per day, but it goes offline and it doesn't come back fast. Even if the regime collapses, even if a new government takes over, bombed oil infrastructure doesn't get fixed in days or weeks. Repairs take months, sometimes years. So the market immediately loses roughly 6,000,000 to 8,000,000 barrels per day of supply. But the document doesn't stop there. It models the secondary effects too. Effect 1, Nicolás Maduro, if he survives the opening strikes, will likely sabotage additional oil facilities to deny them to the United States or to any successor government. A scorched earth play. He has threatened this before. The document estimates he could sabotage infrastructure representing another 2,000,000 to 4,000,000 barrels per day. Effect 2, regional instability. Other Latin American countries, especially Bolivia, Nicaragua, and possibly Ecuador, could restrict or even pause oil exports in solidarity with Venezuela or simply out of fear they might be next. Estimated impact, 1,000,000 to 3,000,000 barrels per day. Added up 6,000,000 to 8,000,000 barrels per day lost from direct strike damage, 2,000,000 to 4,000,000 from Venezuelan sabotage, 1,000,000 to 3,000,000 from regional spillover, total 9,000,000 to 1.5 million barrels per day removed from global supply. That's roughly 1% to 1.5% of worldwide demand, which sits around 100 million barrels per day. So how does the market respond? The document runs three cases. Conservative scenario, oil climbs from $75 to $135, a $60 jump. Moderate scenario, oil rises to $180, a $105 jump. Aggressive scenario, oil spikes to $220, a $145 jump. The analysis uses the moderate case, $180, as the baseline for the rest of the modeling. Why would oil hit $180 if supply only falls by about 1%? Because oil markets don't trade purely on today's barrels, they trade on expectations and emotion. Traders aren't just pricing the current balance, they're pricing what they think comes next. And if the United States is bombing Venezuela, the questions start immediately: who's next Iran? Does Iran respond by threatening the Strait of Hormuz? Does Russia squeeze Europe further? Do terrorist attacks target Saudi infrastructure? In that moment, every geopolitical risk premium gets repriced at once. Fear becomes fuel. Speculators pile in, and the move overshoots what the initial supply loss would normally imply. History backs that up. In 1973, the Arab oil embargo cut supply by about 5 million barrels per day, roughly 7% of global demand at the time, and oil went from $3 per barrel to $12, a 400% surge. In 1979, the Iranian Revolution disrupted roughly 4 million barrels per day, and oil jumped from $15 to $40. In 1990, Iraq's invasion of Kuwait removed about 4 million barrels per day, and oil spiked from $17 to $42. In 2022, Russia's invasion of Ukraine created a major perceived supply threat, despite smaller direct disruption, and oil reached $127. The pattern is consistent. Geopolitical shocks drive oil spikes that are wildly out of proportion to the immediate supply hit. That's why $180 oil becomes the Pentagon's base case. Now, what does $180 oil do to inflation? The document estimates that sustained $180 crude adds 4 to 6 percentage points to the consumer price index within 3 months. If CPI is currently around 3%, it jumps to 7% to 9%. At the pump U.S., gasoline goes from about $3.50 per gallon to $8 to $10 per gallon. Diesel, heating oil, jet fuel, every petroleum-linked input moves up in the same direction. Transportation costs surge. Manufacturing costs surge. Food prices surge because agriculture and food distribution are energy-heavy. And once inflation fear sets in, investors stampede toward hard assets. Historically, when inflation pushes past 7%, investors run to gold and silver. In 1979 to 1980, U.S., inflation reached 13 to 14%. Gold surged from $220 to $850. Silver climbed from $5 to $50, a tenfold move for silver versus roughly 4 times for gold. Silver led the way. And the Pentagon document points to that same historical pattern. It explicitly states precious metals, particularly silver, exhibit asymmetric upside in high inflation environments due to dual monetary and industrial demand characteristics. The model links the chain oil at $180, inflation at 7 to 9%. And using historical relationships from 1973 to 1974, 1979 to 1980, and 2007 to 2008, it projects silver rising 250 to 350% over 3 to 6 months. But hold on, the document says $347 in 72 hours, not 3 to 6 months. How do you take what looks like a 6-month repricing and squeeze it into 3 days? That's where shockwaves 2 through 5 come in. The oil shock by itself could push silver toward $180 to $200 over a multi-month window. But the other 4 shockwaves all hitting at the same time compress the timeline and magnify the move. Shockwave number 2, BRICS financial retaliation. Venezuela is a partner of the BRICS alliance: Brazil, Russia, India, China, South Africa, and the bloc has recently expanded to include Egypt, Ethiopia, Iran, Saudi Arabia, and the UAE. Venezuela has been pursuing full membership. China in particular has major economic ties to Venezuela: $60 billion invested, oil purchase agreements, infrastructure deals, and political backing. If the U.S. bombs Venezuela, China isn't going to respond militarily. China isn't going to trigger World War III over Venezuela. But China will retaliate economically, and the Pentagon document lays out exactly what that could look like. Retaliation tool number 1, a U.S. Treasury dump. China holds roughly $1 trillion in U.S. Treasury securities. Japan holds about another $1 trillion. Other countries collectively hold several trillion more. If China wanted to punish the U.S. for striking Venezuela, one option is to dump treasuries, sell $100 billion, $200 billion, $300 billion of U.S. government bonds into the market. That would drive treasury prices down and push yields sharply higher. If yields jump, borrowing costs for the U.S. government rise, mortgage rates rise, corporate financing costs rise, the entire economy feels it. The analysis assesses China could offload $200 to $500 billion in treasuries within 72 hours of a Venezuela strike, with the moderate case set at $300 billion. What does that do? 10-year yields currently around 4% could leap to 6 or 7%. That's enormous. And when yields spike like that, it screams stress. It signals foreign creditors are losing confidence in U.S. debt, and that sparks capital flight. Money rushes out of bonds. Where does it go? Stocks? No, stocks are sliding because of war risk and the oil shock. Commodities, yes. Precious metals, absolutely. Retaliation tool number 2, rare earth export restrictions. China produces about 70% of the world's rare earth elements. These are essential for electronics, batteries, defense systems, and renewable energy. If China wanted to hit U.S. industry where it hurts, they could impose rare earth export limits. The document notes China has floated this threat before during trade war flare-ups in 2019 and 2023. They've never fully pulled the trigger, but a U.S. strike on their Venezuelan partner could be the catalyst. The assessment assigns a 50 to 70% probability of Chinese rare earth export restrictions within 72 hours of a strike. Retaliation tool number 3, accelerated de-dollarization. China and Russia have spent years trying to shrink reliance on the U.S. dollar in global trade. They've pushed the yuan and the ruble, built up gold reserves, and developed alternative payment rails intended to bypass SWIFT. A U.S. attack on Venezuela, the document argues, would be used as justification to fast-track that effort. The projection is that within 72 hours, China could announce that effective immediately, all Chinese commodity exports must be settled in yuan, not dollars. BRICS trade would shift to BRICS currencies or gold, not dollars. That would be a huge symbolic hit and a practical strike against dollar dominance. And when the dollar's reserve currency status is questioned, when foreign holders are unloading treasuries, and de-dollarization suddenly accelerates capital runs from the dollar. The dollar index, which tracks the dollar against a basket of currencies, would plunge. The document forecasts a 10 to 20% dollar drop within 72 hours. A 10 to 20% collapse in 3 days would be without precedent in the modern era. When the dollar falls like that, dollar-denominated assets get repriced downward. But hard assets, things priced in dollars yet anchored by intrinsic value, tend to surge. Gold and silver become the primary winners. The document includes a dedicated section on precious metals as a BRICS retaliation lever. It notes that China and Russia are both major gold and silver producers. Russia produces about 300 tons of gold per year and ranks among the top 10 silver producers. China produces about 370 tons of gold annually and roughly 3,500 tons of silver per year. If China and Russia chose to weaponize precious metals, the document argues they have 2 obvious options. First, ban all gold and silver exports and keep output at home. That yanks supply from global markets and forces prices higher. Second, deploy state resources to buy gold and silver in international markets, pushing prices up even further. The assessment assigns a high probability 70 to 90% that China announces a precious metals export ban within 72 hours of a U.S. strike on Venezuela. It also assigns a moderate probability 40 to 60% that China and Russia coordinate active gold and silver buying internationally as a way to drain Western financial capacity and weaken confidence in fiat currencies. If both occur, if China cuts off exports while also buying aggressively, the impact on silver is disastrous. Remember, China produces around 3,500 tons of silver per year, or roughly 112 million troy ounces. If that supply vanishes from the global market and China is simultaneously bidding for another 100 to 200 million ounces on the open market, the global supply-demand balance snaps. Current global silver production is roughly 1 billion ounces per year. Current demand is also about 1 billion ounces, basically balanced. But if China pulls 112 million ounces of supply and simultaneously adds 100 to 200 million ounces of demand, that's a swing of 212 to 312 million ounces. All of a sudden, the market is short by 20 to 30%. Prices have to jump hard enough to destroy demand. And the document's math says that eliminating 20 to 30% of industrial demand would require silver prices in the $250 to $400 range. Industrial users simply can't operate with silver at $300, so they cut production. They switch to alternatives. They ration. That's how the market rebalances, through price-driven demand destruction. So shockwave number 2, BRICS financial retaliation, adds another $100 to $150 onto silver beyond what the oil shock alone would do. The oil shock gets you to $150 to $200. BRICS retaliation pushes you to $250 to $350, and we're still not finished. Shockwave number 3, Latin American supply chain contagion. Silver production is geographically concentrated. The top 5 silver-producing countries are Mexico, Peru, China, Chile, and Australia. Together, those 5 account for about 65% of global supply. Mexico is number 1 at roughly 190 million ounces per year. Peru is number 2 at about 130 million ounces. Those 2 alone make up around 32% of global production. And both are in Latin America, both are in Venezuela's neighborhood, so both could feel the shock of a U.S. strike on Venezuela. Peru has a left-leaning government that has historically shown sympathy toward Venezuela. If the U.S. bombs Venezuela, the document expects major protests in Peru. Anti-American sentiment spikes, and the Peruvian government could face domestic pressure to condemn the U.S. and respond. One response could be to restrict or pause silver exports to the United States, not forever, but temporarily as a symbolic move. Or they could slap on an export tax that makes Peruvian silver more expensive. Or they could even move toward nationalizing foreign-owned mining operations. The document flags these risks and points to precedent. It notes that in 2006, during tensions involving the U.S. and Bolivia, Bolivia's president Evo Morales nationalized the natural gas industry and pushed out foreign firms. In 2007, Venezuela nationalized oil projects. In 2008, Ecuador expelled a U.S. military base. Latin American governments have a track record of anti-U.S. actions when they feel threatened or when nationalist pressure runs hot. A U.S. bombing of Venezuela would create exactly that kind of atmosphere. The document assigns a 30 to 50% probability that Peru restricts silver exports within 72 hours of a strike. If Peru restricts exports, that's 130 million ounces per year removed from the accessible global flow, about 11 million ounces per month, or roughly 365,000 ounces per day. Over 72 hours, that's around 1 million ounces that expected buyers suddenly can't reach. Not massive by itself, but in a market already strained by Chinese export bans and panic buying, every million ounces counts. Mexico is a different story. Mexico's relationship with the United States is more complicated. Deep trade integration, a shared border. But Mexico also has a long tradition of nationalism and resistance to U.S. intervention across Latin America. Depending on who's in power at the time of a hypothetical strike, the Mexican government could face pressure from the public and from regional partners to condemn Washington and respond in some way. The document assigns a 20 to 40% probability of Mexican export restrictions. But even if Mexico and Peru never formally announce limits, the analysis highlights additional vulnerabilities. Mining across Latin America is already prone to disruptions, labor walkouts, local community protests, environmental conflicts, permitting slowdowns, and security problems. A regional crisis like a U.S. bombing campaign against Venezuela could intensify all of it. Workers could strike in solidarity. Communities could block access roads. Governments could drag their feet on approvals for foreign operators. The document argues that even a 10 to 20% drop in mining output across Peru, Mexico, Chile, and Bolivia, purely from heightened instability and friction, could remove 50 to 100 million ounces from annual production, or roughly 4 to 8 million ounces per month. Add up the Latin American supply exposure. Peru, potential export limits 130 million ounces per year at risk. Mexico, potential export limits 190 million ounces per year at risk. Broad mining disruptions, 50 to 100 million ounces per year at risk. Total 370 to 420 million ounces per year at risk, or around 30 to 35 million ounces per month. And if these threats appear suddenly within 72 hours of a strike, the market doesn't wait for the metal to actually disappear. It panics because future supply becomes uncertain. Buyers rush to lock in today's inventory before it's gone tomorrow. Prices jump. The document estimates that Latin American supply anxiety adds $50 to $100 to silver within the 72-hour window, not because production has already vanished, but because markets price the risk. If buyers believe silver might not be available next month, they'll pay almost anything to secure it now. That's panic buying. Hoarding that sends prices nearly vertical. So at this point, the stack looks like this. Oil shock, adding $100 to $150. BRICS retaliation, adding $100 to $150. Latin American supply fears, adding $50 to $100. Total so far, $250 to $400. And there are still 2 shockwaves left. Shockwave number 4, institutional safe haven panic. When war erupts, when oil doubles, when inflation accelerates, when the dollar slides, when geopolitical risk explodes, institutions panic. Pension funds, endowments, sovereign wealth funds, family offices, hedge funds, these are the players managing trillions, and they operate under risk management rules. When certain indicators cross specific thresholds, they're forced to rebalance. They must cut exposure to risk assets and raise allocations to perceived safe havens. The document models how much capital could rotate into safe haven assets in a Venezuela strike scenario. It starts with global equity markets. Global stock market capitalization is roughly $100 trillion. In a war-driven scenario, oil surging and inflation ripping higher, the document projects equities dropping 5 to 10% within 72 hours. The base case drawdown is about 7%, which translates to roughly $7 trillion of market value wiped out. Now, not all of that money can instantly move. A lot of it sits with retail holders who don't react fast. A lot sits in passive index products that don't rebalance day to day. But institutional capital, actively managed mandates, does react. And the document estimates that within 72 hours, about $3 to $5 trillion of institutional money would attempt to reduce equity exposure or rotate out of stocks. So where does it go? Some flows into cash, but cash is getting punished if inflation is jumping and the dollar is sliding. Some tries to go into bonds, but bonds are also under pressure if China is dumping treasuries and yields are spiking. Some rotates into commodities, energy, agriculture, industrial metals, and a meaningful slice targets precious metals. The document estimates that 10 to 15% of the capital leaving equities would shift into precious metals. That's roughly $300 billion to $750 billion. Put that next to the size of the metals markets. The global gold market has an above-ground stock around 200,000 tons, about 6.5 billion ounces worth roughly $14 trillion at current prices. The global silver market has around 3 billion ounces above ground, worth about $230 billion at today's prices. In dollar terms, gold is about 60 times larger than silver. Normally, institutional safe haven demand concentrates in gold. But in this scenario, the document highlights several reasons silver would receive a disproportionate share of the flow. Factor 1, relative valuation. Gold is around $2, 100 per ounce. Silver is about $78. For investors expecting a major upside move, silver offers a larger percentage runway. If gold doubles to $4.200, that's a 100% gain. If silver runs to $300, that's about a 285% gain. Factor 2, the supply squeeze is more visible. The China export ban, narrative, COMEX, stress vault drawdowns, dealer shortages, those signals have made silver's tightness more obvious than gold's. Institutions are aware of the silver supply problem, and scarcity itself becomes a magnet. Factor 3, an industrial demand anchor. Silver isn't purely monetary, it's used in solar electronics, EVs, and more. That creates a demand base that can support pricing even if investment flows cool later. Gold doesn't have the same industrial backstop, so silver can look less asymmetric on the downside. Because of these factors, the document projects silver could capture 20 to 30% of precious metals inflows, even though silver is a much smaller slice of the total precious metals complex. If $300 billion to $750 billion is moving into precious metals and 20 to 30% targets silver, that means $60 billion to $225 billion chasing silver. At $78 per ounce, $60 billion equals roughly 770 million ounces. $225 billion equals roughly 2.9 billion ounces. Annual global silver production is about 1 billion ounces. So in 72 hours, the modeled inflow is effectively trying to buy anywhere from 6 months to 3 years of mine supply. That's not absorbable. There isn't enough immediately available inventory. So the only way the market clears is price silver has to reprice violently until marginal buyers are forced to step back. How far does silver have to run for the market to clear? The document applies a demand elasticity framework. It estimates that around $150 demand destruction starts, some buyers step back. At $250, about 50% of incremental demand gets priced out. By $400, roughly 75% is priced out. So equilibrium lands somewhere in the $200 to $400 zone, depending on how aggressive the wave of buying becomes. The institutional safe haven surge alone, shockwave number 4, could theoretically tack on $150 to $250 to silver within 72 hours, simply because so much capital is trying to force its way into a market that's far too small to absorb it. Stack that on top of the first 3 shockwaves and you're already talking $400 to $600. But the document stays more restrained because it assumes the flows don't all arrive at the exact same moment, and it assumes a portion of buyers are price sensitive and drop out as the price jumps. So it uses a smaller contribution, $100 to $150 from institutional rotation, running total oil shock $100 to $150, BRICS retaliation $100 to $150, Latin American supply fears $50 to $100, institutional safe haven $100 to $150. That puts you at $350 to $550 with a midpoint around $450. So why is the document's final number $347? Because it also builds in offsetting forces. It assumes some speculative selling. It assumes profit-taking kicks in. It assumes COMEX attempts to cap the move through margin hikes and trading halts. So it shaves the peak by roughly $100 and lands on $347 as the 72-hour target. But there's still one more shockwave. Shockwave number 5, retail and crypto panic. While institutions are shifting trillions, retail investors and crypto holders are reacting for a different set of reasons. Crypto, especially Bitcoin and other tokens, has been sold as digital gold. The pitch is that crypto is a safe haven, an inflation hedge, a store of value, but that storyline has never been stress tested in an actual war-driven crisis. And the document argues crypto fails that test. Why? Because crypto has no intrinsic value. It isn't backed by anything tangible. It's code. And in a war when oil is surging, inflation is accelerating, and the dollar is sliding, people want something real. They want physical. They want gold. They want silver. They don't want digital tokens. The projection is that crypto markets currently worth about $2 trillion in total would drop 30 to 50% within 72 hours. Bitcoin from $45,000 to $22,000 to $30,000. Ethereum, Solana, everything sliding hard. And the moment the safe haven crowd realizes crypto isn't acting like a haven at all, that it's behaving like a high-risk speculative trade that breaks when real stress hits, they sell. They unwind. They look for assets that actually function as refuges. Some go to cash. Some try bonds. But many, especially those who bought the digital gold narrative, rotate into actual gold, actual silver, physical metals. The document estimates that 20 to 30% of the capital leaving crypto would move into precious metals. If crypto loses $1 trillion in market value and 25% of that rotates into metals, that's $250 billion. And once again, it's the same problem, a tidal wave of money trying to squeeze into a market that's tiny by comparison, while silver takes an outsized share because it's cheaper, easier to access, and wrapped in the supply squeeze. Narrative. Retail investors who aren't even in crypto panic too. They see the headlines. U.S. strikes Venezuela oil surges, stocks dump, inflation accelerates, and they think, I have to protect my savings. What do they reach for? Gold and silver. Everyone recognizes gold and silver as classic safe havens. That's been true for thousands of years. So they rush dealers. They shop online. They try to place orders and they hit a wall. Dealers are wiped out. Inventory is already gone because Norway and Saudi buying cleared shelves because COMEX stress triggered a run because the vault is drained. Retail discovers there's no physical available, and the handful of dealers with any supply left are quoting $300, $400, $500 per ounce, and retail still pays because fear takes over and they don't know what else to do. The document estimates retail and crypto panic adds another $50 to $75 to silver within the 72-hour window. Not as powerful as the institutional wave, but still meaningful. And more importantly, retail panic is what sends physical premiums into the stratosphere. COMEX might print $200, but dealers are at $400 or $500 because retail is bidding whatever it takes to secure real metal. 5 shockwaves. Oil explosion, $100 to $150. BRICS retaliation, $100 to $150. Latin American supply fears, $50 to $100. Institutional safe haven, $100 to $150. Retail and crypto panic, $50 to $75. Added up. Low end, $400, high end, $625, midpoint, $512. Yet the document staying conservative lands on $347. It assumes the bottom end of each band, and it bakes in dampening forces like trading halts and intervention. $347 is the official Pentagon projection, and that's the number I'm giving you. Now, let me show you the 72-hour timeline. How do you go from $78 today to $347 in 3 days? The document lays out an hour-by-hour sequence. I'm going to compress it, but I'll give you the key markers. Hour 0, first strike. Let's say it happens at 2 a.m. Eastern Time. Cruise missiles launch from U.S. Navy ships. Targets key government sites in Caracas. Military command locations, major oil facilities. The strikes are coordinated, precise, and overwhelming. Within 30 minutes, social media is saturated with footage, blasts, fires, confusion. Within 1 hour, news networks switch to non-stop breaking coverage. U.S. attacks Venezuela. Markets respond immediately. Asia is open. It's daytime in Tokyo, Hong Kong, Singapore. Equity markets start sliding fast. Nikkei down 3% in the first hour. Hang Seng down 4%. Oil futures on Asian venues gap higher from $75 to $110, a $35 jump. Silver trading on Asian exchanges gaps from $78 to $115, a $37 jump. Why such a violent move? Because traders in Asia can see what's next. They know oil is headed higher. They know safe haven demand is about to surge. So they front run it, they buy first and ask questions later. Gold gaps from $2.100 to $2.400. Silver jumps to $115. Hour 6. It's now 8:00 a.m. Eastern. Europe opens London, Frankfurt, Paris, and it's pure chaos from the first print. The FTSE is down 5%. The DAX is down 6%. Oil is now at $125. Asia drove it from $110 to $125 in 6 hours. Silver is trading at $135. Gold is at $2.500. Crypto is sliding fast. Bitcoin down 15% to $38,000. European desks are dumping equities and piling into commodities and metals. Hour 12. It's now 2:00 p.m. Eastern, U.S. Markets have been open for about 4.5 hours. They opened at 9:30 a.m., and it was a bloodbath. The S&P 500 gapped down 6% at the open. The Dow is down 5%. The Nasdaq is down 7% because tech gets treated as higher risk. Circuit breakers have already hit twice. Trading halted for 15 minutes each time. Oil tagged $140, silver tagged $158. Then profit-taking showed up. Some traders who bought at $115 are selling at $158, locking in $43 gains in 12 hours. Silver dips back to $145. Gold slips back to $2,450. But the real action is happening off-camera. China's State Council holds an emergency session. They decide to dump $300 billion in U.S. treasuries. Ban all silver exports effective immediately. Coordinate with Russia and Iran. Within an hour, it leaks. Bloomberg at 3:47 p.m. China to sell $300 in treasuries, sources say. Reuters at 4:02 p.m. China bans silver exports in retaliation for Venezuela strikes. The market detonates. Hour 18. It's now 8:00 p.m. Eastern, U.S. Markets are closed, but Asia is about to reopen for the next trading day, and the China headlines are everywhere. Treasury yields rip higher. The 10-year yield jumps from 4% to 5.8% in after-hours trading. The dollar breaks. The dollar index is down 8%. And silver trading electronically rockets from $145 to $197 in 1 hour, a $52 blast, because everyone realizes China just pulled 112 million ounces per year out of the market, and China may also be buying. The scramble begins. Hour 24. One day after the strike, Asian markets open for their second session since the attack. The Nikkei drops another 4%. The Hang Seng dumps 6%. Oil is at $165, silver is at $215, gold is at $2,700. The moves are speeding up, not cooling off, because fear is stacking on fear. Institutions are panicking. Pension funds are calling brokers. Reduce equities. Buy gold and silver. I don't care about the price. Peru announces it is suspending silver exports pending review. Mexico says it is considering export taxes. Bolivia nationalizes a foreign-owned mine. The Latin American dominoes are starting to fall. Silver spikes from $215 to $248 in 2 hours. U.S. Dealers are completely wiped out. Zero inventory. Premiums are running 150%. If COMEX is printing $248, any dealer who still has metal is quoting $450 to $500, and people are paying it. Hour 48. 2 days after the strike, the U.S. government tries to step in. The president gives a speech. These strikes were limited. We accomplished our objectives. We are not pursuing regime change. We urge calm in the markets. It doesn't land. Nobody buys it. The damage is already baked in. Oil is at $178. Silver is at $281. Institutional inflows are cresting. Sovereign wealth funds in the Middle East are bidding for everything. Norway is buying. Saudi is buying. Everyone is buying, and there's nothing left to source. COMEX registered inventory is down to 1.2 million ounces from 5.8 million a week earlier. Meanwhile, orders for 9 million ounces are outstanding. They can't be delivered. COMEX announces an emergency pause. Silver futures trading is suspended pending review. Hour 72. 3 days after the strike. COMEX is frozen, but London is still trading. Zurich is still trading. Hong Kong is still trading. Prices across those venues print anywhere from $320 to $360 depending on where you look. The average $347 the Pentagon's projection. And physical, the retail dealer market is at $500 to $600 for the tiny handful of dealers who still have anything. Most aren't selling at all. They're waiting to see how high it goes. That's the 72-hour path. Hour 0, $78. Hour 6, $115. Hour 12, $158. Hour 18, $197. Hour 24, $215. Hour 48, $281. Hour 72, $347. And it doesn't end there. The document projects silver keeps climbing to $400 to $500 over the following 2 weeks, as the shortage becomes impossible to deny and more institutions complete their allocation and execution cycles. Now I want to address the question you're probably thinking, is this realistic? Can silver really hit $347 in 3 days? My answer, yes. History shows commodities can move violently fast during crisis conditions. Oil went from $30 to $147 in 18 months, 2007, 2008, about a 390% move. Silver ran from $5 to $50. In 12 months, 1,979, 1,980, a 900% move. In this scenario, silver moves from $78 to $347. In 3 days, a 344% increase. It's faster than past examples, but it's not an entirely different universe. It's the same type of repricing, just condensed. Why condensed? Because information travels instantly now. In 1979, news moved slowly. People waited for papers. They called brokers. Decisions took days. Today, investors see headlines and posts in real time. Trades are executed in seconds. Algorithms respond in milliseconds. A move that once took a year can happen in 3 days in 2026 because the speed of information and the speed of capital are radically higher, and because this scenario stacks multiple crises on top of each other at the same time. The 1979 to 1980 silver surge was driven by runaway inflation and the Hunt brothers buying spree. This scenario is powered by an oil shock, BRICS retaliation, supply disruption, safe haven rotations, retail fear, and a crypto unwind hitting all at the same time. It's like 5 separate crises fused into one, so the scale of the move shouldn't surprise anyone. The Pentagon takes it seriously. They built the model, they stress-tested the paths, they have data and institutional expertise that go far beyond what any lone analyst can access. And their conclusion is simple: $347 in 72 hours. I'm not inventing that. I'm relaying what the document states. So what's the move? What's the action plan? If you think this scenario is even remotely possible, if you assign it a 10% or 20% chance, what should you do right now to prepare? Action number 1, buy physical silver immediately. Not later, not when you get around to it. Right now. Go to a dealer and buy what you can. American Silver Eagles, Canadian Maple Leafs, bars, rounds, whatever is available. Pay the premium. Yes, dealers are quoting $130 to $150 right now, and that looks expensive compared to COMEX at $78. But if this scenario hits, if conflict erupts, $130 is going to look like the deal of a lifetime. You're paying $130 for something that the model projects at $347 in 3 days. That's a 167% gain. That's a once-in-a-generation trade. And physical is the only thing that matters. Don't buy SLV, don't buy futures. In a war scenario, paper markets break, COMEX halts, SLV freezes redemptions. You're stuck with paper that's worthless or cash settled at a fantasy price. Physical is what works. Physical is what institutions want. Physical is what sovereigns want. Physical is what survives. Action number 2, don't wait for confirmation. Don't sit around waiting to see whether war actually begins. The moment the first missile launches, it's already too late. Dealers will be cleaned out within hours. Premiums will explode within hours. You won't be able to source anything. You have to be positioned before the event, not after. That's the entire edge in black swan setups. You buy while everyone else is calm. You buy while prices are still manageable. You buy before the panic. Action number 3, hold through the turbulence. If you buy at $130 and silver runs to $347 in 3 days, you'll feel the urge to cash out. You'll see a 167% gain and think, I should take it. Don't, because $347 isn't necessarily the ceiling. The document projects $400 to $500 in the following 2 weeks. And if the supply crunch is as severe as it appears, if COMEX is effectively dead, if China cuts off exports, if dealers are empty worldwide, silver could overshoot dramatically. $800, even $1.500, nobody can call the top in a true panic. So don't dump at $347. Hold until the supply picture stabilizes and the fear burns off, then reassess. Action number 4, ignore COMEX pricing. In a war scenario, COMEX stops being the reference point. You get halts, force majeure, language, cash settlement games. COMEX might print $200 while physical is trading at $500. Don't anchor to COMEX. Anchor to what real metal costs in the real market. The only real price is the price you can actually buy and sell physical for. That's the only number that matters. COMEX is a zombie market. It's already dead, it just hasn't been put in the ground yet. Action number 5, spread the word. Tell your family, tell your friends, tell anyone who will listen, because most people don't even know this scenario is on the table. Most people have never heard about this Pentagon document. Most people are completely unprepared. And when conflict erupts, when silver goes vertical, they're going to panic. They'll try to buy at $300 or $400 and they'll find nothing available. But if you warn them now, if you tell them to position at $130, you could change their financial lives. You could keep them from getting crushed. Be that person. Share this video. Share this information. Now, I need to be crystal clear about something. I am not saying war is about to happen. I'm not claiming the U.S. will definitely strike Venezuela tomorrow, next week, or next month. I do not have inside access to military planning. What I am saying is this: the Pentagon has prepared for this scenario. They've studied it. They've run the numbers. And their analysis shows that if it happens, silver reaches $347 within 72 hours. That's not speculation. That's what the document states. The document exists. The analysis exists. The projection exists. Whether war actually happens is a political choice. It depends on the president. It depends on Congress. It depends on public mood. It depends on international pressure. It depends on 1,000 variables I can't forecast. But I can tell you the ingredients are there, the tensions are real, the incentives are real, the capability is real, and history shows the U.S. has intervened militarily in Latin America before. It has happened, It can happen again. So this isn't fantasy. This isn't science fiction. It's a real-world possibility that serious people inside the Pentagon have modeled in detail. And their conclusion is blunt. War equals silver moon. $347. 72 hours. The fastest, most violent repricing of any commodity in modern times. And even if war never happens, even if this exact Venezuela scenario never plays out, the analysis still matters. It shows how tightly linked global markets are. It shows how a geopolitical shock can cascade into a broader financial crisis. It shows why precious metals become the ultimate refuge when confidence breaks. And it shows why silver specifically has asymmetric upside in crisis conditions, because the market is small, supply is tight, and demand becomes explosive when fear takes over. Subscribe to the channel, turn on notifications, share this video with everyone because the Pentagon document is real, the $347 projection is real, the 72-hour timeline is real. And whether it happens because of Venezuela or because of some other black swan event, the lesson doesn't change. Own physical silver. Own it now. Own it before the crisis hits. Because once the crisis starts, it's already too late. Dealers are wiped out, premiums blow out to 300%, the vault is empty, and the only people who come out ahead are the ones who positioned early. I've just walked you through the Pentagon's scenario analysis, 47 pages classified secret, a Venezuela military intervention model, 5 shockwaves, a 72-hour timeline, and a silver target of $347. This isn't my opinion. This isn't my guess. This is presented as a United States Department of Defense strategic assessment. They modeled it. They ran the numbers. They put it in writing. And I'm bringing it to you because you have a right to know. You deserve to understand the risk landscape. You deserve the chance to prepare before the event rather than getting trapped after the panic begins. Hold your physical silver. Add more if you're able. And be ready for the possibility that war crisis or some other catalyst sends silver to 300, 400, 500, or higher in a matter of days. The Pentagon's projection is $347 within 72 hours. I take that seriously. This is the Asian guy. January 11th, 2026. War alert. Venezuela scenario. Pentagon document. $347. 72 hours. 5 shockwaves. The ultimate black swan.